While much of the market is seeing strong returns over the last year, the real estate sector has been the opposite, with many REITs in the red and some down as much as 40%. With this, there are 2 REITs in my portfolio whose share prices are diving deeper than Rick Winter's, and in this video, we're going to be talking all about them and why I'm buying more shares for my portfolio right now. But before we get to those, in case you're new to the channel, my name is Ryne Williams, and here we strictly talk about dividend stocks and how you can invest in them to create passive income and reach financial freedom. So if you love dividend stocks and if you're on a mission to retire early, then hit that subscribe button. I'd love to stay in touch as we both continue to grow our portfolios and collect that cash flow. Also, leave me a comment below and let me know which REITs you have in your portfolio. I'd be curious to hear if we have any of the same ones. Anyway, guys, the first real estate investment trust we're talking about today is WP Carey, which has a very diversified portfolio of nearly 1,500 properties located across the United States and Europe, 99% of which are occupied, which is right in line with their historical occupancy, as you can see here. And out of the 2 REITs that we're talking about today, WP Carey has seen the greater drop in share price out of the 2. Just in the last month, WP Carey is down about 5%. We can see there's been a couple times in the last month where they've really seen some big drops, like here, for example. But looking at their year-to-date performance, this company is down about 18.5%, so a very big drop in 2023, which leaves them just about $1 above their 52-week low. Now, with interest rates having been on the rise, it's not much of a surprise to see real estate investment trusts like WP Carey coming down in share price. I talked about this in one of my videos from a couple weeks ago, so I apologize if I'm repeating myself and you've heard this before, but when interest rates go up, it can negatively impact real estate investment trusts in a couple of different ways. First of all, because REITs tend to borrow a lot of money to make acquisitions and buy more properties, higher interest rates and therefore a higher interest expense can cut into the cash flow generated on any new acquisitions that these companies make, which means that it's harder for them to generate income. Furthermore, if these companies have variable loans where the rates can fluctuate, higher interest rates will have an impact there as well and will increase the amount of interest expense the company has to pay on any pre-existing loans with a floating rate. Additionally, when interest rates rise, many investors flock to other income-producing assets like bonds and treasury bills that come with less risk than real estate investment trusts, so REITs become less attractive to investors, which lowers their demand, which pushes their share prices down. Speaking personally though, as a dividend investor who's continuing to buy stocks every week, I don't mind seeing lower share prices here in the short term because for me, it just means that these great cash flowing assets that I'm going to be buying anyway are now cheaper to purchase, and I can do so while generating more income in the process, because when the share prices go down, the dividend yield goes up. And in the case of WP Carey, whose forward yield at 6.7% is already high as it is, this is about 1.1% above the company's 5-year average. So because the share price has come down, we're getting a much nicer cash flow return today. And not only is the yield high, but along with this, WP Carey has increased their dividend every single year since they went public in 1998, which makes them a dividend aristocrat, and you gotta love that. Now, truth be told, historically, WP Carey isn't a stock that I've added to frequently since it usually is traded quite a bit above my average cost per share. But taking a look at my position using my dividend portfolio tracking spreadsheet, which you can start using for free, there is a link to grab this bad boy in the description of the video. I hope you check it out. But anyway, I have about 24 shares of WP Carey, and we can see the spread between my average cost and the current share price is quite large here. And if we scroll over, this tells us that I'm down about 8%. So I'm taking quite a loss right now, which means that it is prime time to work on building this position out. And I've already started doing so. A couple of weeks ago at the end of August, I picked up 2 shares at just under $65 a share, which is the first time that I've added to WP Carey in months. And as the weeks go on, I want to keep at it. There's a lot of room to continue building this position out in my portfolio, seeing as WP Carey is one of my smaller positions. Here we can see that it only makes up about 3% of my total allocation. So once again, a very small holding of mine. And if we see how my portfolio is diversified by income, WP Carey is still pretty small. It doesn't even make up 5% of the total income. So once again, a lot of room to continue building this out. But anyway, guys, moving on to the second real estate investment trust that I'm currently adding more shares of, probably not much of a surprise, but this one is Realty Income, which announced a couple of weeks ago that it will be taking a page out of Vici Properties' playbook and acquiring a minority stake in the Bellagio here in Las Vegas. Now, I won't burden you with too many of the details since this news is a couple of weeks old at this point, but this investment into the Bellagio marks the second of its kind for Realty Income. Last year, they entered into gaming properties with the acquisition of the Encore Boston Harbor, and I think these moves are actually a much bigger deal for the company than many people are talking about. You see, with a market cap of nearly $40 billion, Realty Income is almost 3 times the size of its next biggest peer in the space, which interestingly enough is WP Carey with a market cap of about $13.6 billion. But anyway, just because of the sheer size of Realty Income, buying more convenience stores or restaurant buildings, which is the type of real estate that makes up the bulk of their portfolio, won't move the needle as much for the company as much as it used to, so it has to look for alternative avenues for growth. Now, as a Las Vegas resident and also obviously a shareholder of Realty Income, I personally think this is a great investment for the company. The property itself is one of the best on the strip, and anytime time you walk through there, the place is absolutely packed with people coming from all ends of the strip to browse the high-end stores, check out the conservatory, or watch the world-famous fountain show. You know, the Bellagio really is a desired destination property and a must-see attraction if you're coming to Vegas. Plus, as far as location on the strip goes, you really can't get any better than the Bellagio, which is located center strip, right in the thick of things next to Caesar's Palace, and also not too far from my favorite place to get a cocktail, the Mojito Hut. At the end of the day, this Bellagio investment proves that Realty Income has the scale and also the capital to do these bigger deals, and it also suggests that they're looking to do things on a bigger scale and in a different way outside of their normal bread and butter moving forward, which, if nothing else, seems like a necessary move to support the company's long-term growth. At any rate, Realty Income still saw some pretty big losses in the last month. I mean, we can see here they're down 7.25%, and then looking at their year-to-date performance, they are down over 13%, which, like WP Carey, puts them just a hair above their 52-week low, and with this drop in share price, we know that dividend yield is just getting pushed up. Looking at the forward yield, this is sitting at about 5.5, which isn't as high as what we saw with WP Carey, but still, this is a really solid yield, guys, and this is also over 1% above the company's 4-year average yield. So just like with WP Carey, getting a higher cash flow return today due to that drop in share price. Not to mention, their track record of growing this dividend is incredibly strong, okay? They've grown it every single year since 1994, which makes them a dividend aristocrat, and they've executed 103 consecutive quarterly increases at a 4.4% dividend growth rate. Now, over the last month or so, I've been buying this one a little bit heavier than WP Carey, and I've added 9 shares to my overall position while buying all the way down from over $60 per share to under $55 per share. And with these purchases, I'm left with about 49 shares of Realty Income, and there's a little bit of a spread here between my average cost and the share price. It's nothing too crazy. I'm seeing more of a loss with WP Carey, 8% like we saw, but with Realty Income, I'm only down 3%, but still a little bit of an opportunity to average down, so I'm going to take advantage of that. And considering Realty Income makes up 5.6% of my portfolio's total weighting, I don't feel at risk of being over-diversified in this position, so I wouldn't mind continuing to pick up some more shares to stack those monthly dividends. And speaking of monthly dividends, check out this next video right over here where I'm telling you about the best and also the worst monthly dividend paying stocks. We'll be reviewing 10 of the most popular monthly payers to see which ones would be worthy additions to your portfolio and also which ones you should just forget about, because there are some bad monthly payers out there. But anyway, click right over here to check that all out, and I'll see you in the next one.